Welcome, dear traders. The new trading week has kicked off. Traders are still digesting the NonForm Payrolls report for May, published last Friday. However, they are also anticipating another crucial economic report, which is due on June 10. This data will be even more important for the Fed than the NonForm Payrolls report. As the result, traders are taking into account last week's data and the upcoming report to choose a proper strategy. What sentiment prevails today in the stock market? Let's find out. The NonForm Payrolls report revealed that the economy added 390,000 new jobs in May. The May figure slightly exceeded the forecast reading of 325,000. It also topped the April indicator of 436,000. The report showed a steady rise on the one hand and a moderate decline on the other. The US stock market climbed last Friday amid such results. However, the hawkish comments of several Fed officials pushed the stocks down. So the equity market closed in the bearish territory once again. Wall Street investors have already factored in a 50 basis point rate hikes in June and July. And the question is whether the regulator will take the same step in September. Strong non-farm payrolls data is likely to be a signal for the Fed to stick to monetary tightening to curb soaring inflation. Yet traders still fear that the aggressive tightening may trigger a recession. They also took notice of the recent comments of Tesla CEO Elon Musk. He wants to cut about 10% of staff because he has a super bad feeling about the economy. The company's shares fell by almost 9%, dragging the NASDAQ and the S&P 500 down as well. As a result, all three US stock indexes closed in the red, losing about 1%. In today's Asian session, US stock futures were moving higher, while the main stock indexes of Japan and Australia were declining. As expected, the non-farm payrolls report had little impact on the US dollar. Traders are more interested in the US consumer price index. They are pinning their hopes on the fact that inflation may decline again. In April, the CPI figure moderately decreased. If the May reading drops further, it may indicate that inflation has already reached its peak. Hence, the likelihood of a soft landing will increase. At the same time, the outlook for the US dollar remains optimistic. The US dollar index, which measures the strength of the currency against six main rivals, was trading at 101.89 during the Asian session. It was moving in the intraday downward channel of 101.85 and 102.21. Nevertheless, analysts stress that the US dollar is trading at relatively higher levels than a few months ago, so it's highly likely to resume an upward movement despite certain obstacles. The dollar-yen pair rose to a new monthly high of 130.99 in the Asian session, ahead of a busy week. As a reminder, the pair approached the 20-year high of 131.34 in May. The trajectory of the pair mainly depends on expectations of the Fed's rate hikes. It's still unclear how aggressively the Fed tighten monetary policy in the future. To this end, the yen will be in a vulnerable position versus the US dollar. The pair is firmly consolidating above 130. However, it may grow to 135.35, the highest level of the current upward cycle. The pair slightly dropped to 130.74 amid the greenback's consolidation. It was moving in the downward range of 130.40 and 130.99. The yen is weakening now due to the return of the risk appetite, rising US treasuries, as well as the soaring oil prices. A surge in oil prices deepened concerns about Japan's trade balance. However, the main reason for the weakness of the Japanese currency is the Bank of Japan's dovish stance. The regulator has more than once highlighted the need to support the economy. To this end, it will stick to its ultra-loose monetary policy. Bank of Japan Governor Haruhiko Kuroda stressed it in his speech today, and he also confirmed that export and import prices are rising due to the weak yen. Therefore, its impact on the market is practically neutral. Meanwhile, the Reserve Bank of Australia is in more hawkish. At tomorrow's meeting, it's expected to raise the cash rate again. It will be the second rate increase in a row. The watchdog may increase the benchmark rate by 25 or even 50 basis points. Some analysts contemplate that the Reserve Bank of Australia Governor Philip Lowe may decide to hike rates more aggressively, for instance by 40 basis points. There are several solid reasons for such a scenario. The labor market is strong, GDP is steadily growing, retail sales as well as wages rose significantly in the first quarter, while traders are awaiting the Reserve Bank of Australia's rate decision. The AUD-USD pair may try to break above the May high, and the pair has already advanced by 0.5% last week. If risk appetite remains strong, the Aussie is highly likely to approach the indicated level. And today the AUD-USD pair is fluctuating between the resistance level of 0.7231 and the support level of 0.7180. It maintains a bullish bias ahead of the Reserve Bank of Australia's meeting. At the time of preparing material for this video, the pair was trading at 0.7231, and the Aussie may also lift higher amid positive news from China and the rising oil prices. And we strive to share with you the latest market news. We hope our video releases help you open gainful positions. Our next video review will be ready in a few hours. Subscribe and leave your comments down below. See you soon.